The United States Liberation Day tariff announcement has unleashed turmoil across global markets, marking one of the most aggressive tax hikes in modern US history, with steep rates targeting most countries and categories. With some exemptions, the policy threatens consumer spending, global trade, and it's affecting economic sentiment. Old Mutual Group Chief Economist Johann warns of a looming US recession, slashing his GDP forecast 2.9% for 2025. While inflation may spike briefly, weaker demand could trigger Federal Reserve rate cuts by June. South Africa faces limited direct impact, but specific sectors and global dynamics remain vulnerable, testing economic resilience worldwide. Good afternoon, and thank you for joining us.
Good afternoon.
You forecast a US recession as your base case due to the liberation tariffs. Can you elaborate on the key factors driving this outlook, and how severe do you expect the downturn to be?
As you mentioned, this constitutes a significant tax hikes on US business and US consumers. And that in its own will lead to much weaker spending from consumers and businesses, and thus leading to this recession. But apart from that, also this on-again, off-again tariff announcements create significant uncertainty. And that on its own will likely lead to significant pushback in terms of spending by consumers and businesses. And just very simply, when we as consumers become very uncertain about the future, we hold back in terms of spending decisions. We rather wait and see what will happen. Same with businesses. Why would they employ more people or spend more in terms of consumer spending, in terms of hiring employees or expanding production capacity? So all of this leads to much weaker economic growth. And that issue then leads to this recession. So I expect negative US economic growth in the second half of the year. And thus, to a large extent, that will be tempered by Fed rate cuts. So as you mentioned, there's likely to be price increases in the short term. But weaker economic growth will likely limit the effect of those price increases. And the Fed will perhaps look through those inflationary impact in the short term, realizing that weaker economic growth is more detrimental to consumers and businesses, and thus start cutting rates.
How do you see the Federal Reserve's potential rate cutting cycle unfolding this year, and under what conditions might we see larger cuts like the 50 or 75 basis points you mentioned?
Good question, because the Fed is one of the most reactive central banks in the world in terms of when there's pain for the economy coming, then they cut significantly. And we've seen in past crises like the global financial crisis in 2008-9 and the COVID crisis in 2020, that when there's such a crisis, they actually start off the cutting cycle by significant cuts, 50 or 75 or even 100 basis points. I don't think 100 or 75 is that likely, but certainly 50 to start off the cutting cycle, especially when growth over the next few weeks and months become much weaker in terms of consumer spending. Retail sales will be watched closely, etc. But already last week we saw a significant slump in consumer sentiment to one of the worst levels on record since those consumer sentiment surveys started in the early 50s. So already consumers are indicating that they're very scared about the future. And I think if this continues, then the Fed's cutting cycle could start in all earnest around June, July this year.
Well, for South Africa, limited direct trade exposure to the US tariffs. Which local industries do you think will face the greatest challenges, and how might they adapt?
So, unfortunately, there will be an impact on the SA economy, but I don't expect a local recession. Certainly, those exports to the US largely will hurt vehicle manufacturing industry, because we export a lot of vehicles to the US, and then also some of the agricultural sectors, wine exports, citrus exports, etc. And it takes some time to find new export destinations, but certainly that is on the cards. We can expect these exporters in these industries to find some alternative routing for their exports. But generally, the rest of the world, because the world is under pressure due to this uncertainty and tariffs, that will also impact on South Africa. Fortunately, I think our other big trading partners like the Euro area and China, they've got room to support the economy. So I don't think we should expect recessions in those areas. So certainly a US recession, but not necessarily in the rest of the world. And I think it's unlikely that the impact on South Africa will be severe. So I don't expect a local recession.
Now, you mentioned the possibility of the South African Reserve Bank cutting rates if inflation falls below 3% in Q2. What are the key risks or opportunities you see for South Africa's monetary policy in this global environment?
Yes. We're lucky in South Africa that we've got a good conservative central bank, which is what we need in an open and a small economy like South Africa's. But with the prospects of inflation falling below 3% over the next few months again, and one example there is that we've seen some weak rand moves over the last week or so, but the fall in the oil price far outweighed the weakness in the rand. So much so that the rand price of a barrel of oil is down 16% since the start of April. So we can expect petrol price cuts again in May and perhaps even in June again. So lower inflation in the second quarter, and when the rand perhaps stabilizes in line with a weaker dollar, then the Reserve Bank, in the face of US Fed rate cuts, can also start to cut rates again in South Africa. But I do think that in South Africa, we're unlikely to have rate cuts of the magnitude that we're going to see in the US. Perhaps 25 to 50 basis point rate cuts locally versus around 100 to 125, perhaps even more in the US. So that difference already will be some support for the rand exchange rate as well.
And then the uncertainty around the government of national unity and the DA's participation seems to weigh on investor confidence quite a lot. Now, what steps do you think government needs to take to stabilise the GNU and boost economic sentiment?
We see politics at play here, but I think both of the two bigger parties in the GNU realizes that it's in the best interest of the country to sort out these differences. And I think sanity should prevail, and I think that we will continue with the GNU in its current form because that's what's best for the economy and for local conditions, especially when the global situation is so uncertain. That's even more need to sort this out ASAP. But also, I think both of those parties are fairly pragmatic in the sense that they realize this bigger role that they've allowed the private sector over the past few years, and even before the formation of the GNU, in terms of allowing the private sector to generate electricity, get involved in transnets, logistical functions, etc. That's going to drive better economic growth down the line. So we need to do absolutely a lot more in terms of making sure those policies are implemented hastily, and expand in terms of those policies. Make it as easy as possible and as cheap as possible for the private sector to participate in these functions where the state and state-owned enterprises really have failed in the past. So we can expand economic activity if we continue build confidence through better policies and better policy implementation.
Thank you so much for chatting to us today. That was the Chief Economist, Johann from Old Mutual Group.